Hello everyone, I am Kota from Scopes Data. Today, we're diving into the world of GHG accounting for fleet operations. We're going to unpack how greenhouse gas emissions are measured and managed in our ever-evolving, environmentally conscious business landscape. Our journey will take us through the GHG Protocol's complexities, the critical need for emissions reporting, and the various scopes of GHG emissions, especially as they apply to vehicle fleets. Whether you're well-versed in environmental management or new to GHG accounting, our insights today will equip you with the knowledge to effectively navigate this key area of corporate responsibility. So, let's get started on our path to a more sustainable and informed future. Let's talk about the GHG Protocol. Imagine a global framework, one that's been shaping the way we measure and manage greenhouse gas emissions for over 2 decades. That's the GHG Protocol for you. The protocol started as a collaboration between the World Resources Institute, WRI, and the World Business Council for Sustainable Development, WBCSD. Together, they've created something that's become a standard, not just for companies, but for governments and organizations across the globe. Think back to the late 1990s. That's when the need for a standardized way to account for GHG really became clear. So, the WRI and WBCSD came together with other corporate and environmental groups and laid the groundwork for what would become the first corporate standard of the GHG Protocol, published in 2001. Since then, they've been regularly updating it, expanding to include a whole range of emission sources like electricity and complete value chains. Fast forward to today, and the GHG Protocol is central to global climate change efforts. It's the go-to framework for GHG reporting for leading companies all around the world. More than that, it plays a critical role in national and city-level environmental initiatives, syncing up with major global commitments like the Paris Agreement. The GHG Protocol isn't just sitting still. It's continuously evolving through its advisory and technical groups. They're always working on new tools and training programs to keep up with the ever-changing climate goals and strategies. So, when we talk about a benchmark in standardized greenhouse gas accounting and reporting, the GHG Protocol is it. Let's dive into something truly important. Why organizations, especially those with corporate fleets, really need to report their greenhouse gas emissions. You see, aligning with initiatives like the Science Based Targets Initiative, or SBTI, is more than just setting ambitious environmental goals. It's like joining a race to the top in corporate responsibility. Already, we're seeing thousands of organizations stepping up, setting science-based targets to move towards a zero-carbon future. But here's a question. Why is disclosing this information, say through platforms like the Carbon Disclosure Project, so vital? Well, for over 23,000 companies, it's the cornerstone of building a climate-safe and sustainable future. This kind of disclosure goes way beyond just meeting investor or customer expectations. It's about getting that competitive edge, discovering new risks and opportunities, and staying ahead in a world that's increasingly demanding transparency in environmental matters. And here's something you need to know. The European Corporate Sustainability Reporting Directive, or CSRD, is kicking in from 2025. This makes reporting not just a good to-do, but a must-do. Think about this. With significant global assets and purchasing power focused on environmental disclosure, companies stand to gain a lot. We're talking about an improved reputation, getting a leg up in the market, crafting informed strategies, and staying in line with evolving regulations like the TCFD recommendations. In short, disclosing environmental data isn't just a tick in the box of corporate responsibility. It's a key strategic move, a business imperative that can't be overlooked. So, when we talk about GHG emissions reporting, remember, it's not just about being responsible, it's about being smart, forward-thinking, and strategically positioned for the future. I am going to delve into the essential aspects of GHG scope classifications in corporate greenhouse gas reporting. There are 2 primary methodologies utilized in this process, the equity share approach and the control approach. We'll be focusing predominantly on the control approach, specifically the operational control criteria, which is commonly adopted by corporations. Let's begin with an overview of the GHG scopes. Scope 1 include direct emissions from sources owned or controlled by an organization. This refers to emissions directly from the combustion of fossil fuels in vehicles owned or operationally leased by the company. However, it's important to note that this does not extend to vehicles provided through cash allowance or those owned by employees. Accurate identification and management of Scope 1 emissions are critical for developing effective emission reduction strategies. Moving on to Scope 2, which pertains to indirect emissions from the consumption of purchased electricity, steam, heating, or cooling. In the context of vehicle fleets, Scope 2 is particularly relevant to the electricity consumed by electric vehicles that are owned and leased by the company. Precise reporting within this scope depends on a thorough understanding of the electricity consumed and the emission factors of the electricity grid. This data is instrumental in formulating strategies to reduce emissions, such as transitioning to renewable energy sources or procuring green electricity contracts. Finally, Scope 3, which includes all other indirect emissions occurring in an organization's value chain. For fleets, this includes emissions from employee business travel and employee commuting for vehicles not accounted for in Scope 1 and 2. These emissions are contingent upon the operational control status of the vehicle and the purpose of its use. Comprehensive understanding of Scope 3 emissions is vital for organizations to develop strategies that reduce their overall environmental impact and promote sustainable commuting options. By comprehensively understanding and categorizing emissions according to these scopes, organizations can ensure accurate and effective GHG reporting. This understanding is crucial for fleet managers and environmental accountants as they work to align their strategies with broader corporate sustainability goals. As we've just covered the importance of reporting GHG emissions, it's now crucial to delve into an often underestimated aspect of this area, the significance of fleet emissions. Though the necessity of GHG reporting is clear, the critical role of the fleet in the overall emissions landscape might not be as widely recognized. That's precisely why I would like to talk before we deep dive into more technical content. In the context of GHG emissions reduction, many companies have publicly committed to reducing Scope 1 and Scope 2 emissions as part of their Science-Based Targets initiative goals. A common target is a 50% reduction by 2030 compared to base year emissions, which often range from 2018 to 2022. In manufacturing sectors where fuel is used in production processes, the proportion of Scope 1 emissions from the fleet may be relatively small. However, in industries that don't rely on fuel for production, such as those using electric machinery or in the IT and service sectors, the majority of Scope 1 emissions typically come from fleet operations. Reducing emissions in factories and offices might be more straightforward than in fleets. Manufacturing industries can optimize machinery efficiency or adopt CO2 capturing technologies to curb emissions. Similarly, reductions in electrical systems can be achieved through on-site generation or procurement of renewable electricity. The effectiveness of these actions often comes from the ease of capturing current emission levels, the clarity of the reduction actions, and the fact that these actions don't directly impact individual employee benefits. However, managing fleet emissions presents unique challenges. Current fleet emissions are harder to quantify, and transitioning to electric vehicles may not be feasible or as effective in all countries. Negotiating with individual drivers and implementing actionable changes can be more difficult. As a result, while significant GHG reductions have been achieved in other sections, such as manufacturing, production plants, offices, and so on over the past few years, the impact of fleet electrification has been limited for many companies. However, the pressure on fleet management to contribute to corporate GHG reduction targets is likely to increase. Unlike other areas, fleet emissions reduction faces significant hurdles. An early understanding of the current state and strategic planning are essential to overcome these challenges. Without addressing fleet emissions effectively, many companies risk falling short of their Scope 1 and 2 reduction targets. With fleets, being a critical factor in this shortfall. I would like to dive into the topic of vehicles and GHG scope classifications in fleet GHG accounting. This is a crucial area as it directly influences how emissions from different types of vehicles are classified and reported. Firstly, let's talk about vehicles that are under the operational control of the company. These include company-owned or company-leased vehicles. The CO2e emissions from these vehicles are reported under Scope 1, which covers direct fuel combustion emissions. Additionally, for electric vehicles, the indirect emissions from electricity consumption are categorized under Scope 2. This dual classification reflects the direct and indirect emission sources of the company's fleet. On the other hand, we have vehicles that are not under the company's operational control. This category includes vehicles that employees have purchased through a cash allowance, their personally owned vehicles, and those used for short-term rentals or car sharing. Typically, emissions from these vehicles fall outside of Scope 1 and Scope 2. Now, here's an important point from the GHG Protocol. It provides a method for including all company-purchased fuel under Scope 1 emissions. This means that emissions from employee private vehicles, which are not operationally controlled by the company, may still be reported under Scope 1 if the company is the one purchasing the fuel. The application of this method depends heavily on the company's specific reporting policy. For fleet managers, this brings up an essential task: engaging in discussions with your sustainability team to decide how these emissions should be reported. Reporting methods might vary from one company to another, but what remains vital is the data collection approach. It's imperative to collect data in a manner that allows for the clear separation of emissions based on the vehicle's control type. This distinction is crucial even if a specific reporting policy is already in place, as retrospective separation of this data can pose significant challenges. By categorizing emissions accurately based on the control type of vehicles, organizations can achieve comprehensive and precise accounting of their emissions. This is not just about compliance. It's about forming the foundation for effective emission reduction strategies and enhancing environmental impact management. Let's dive into an important aspect of fleet GHG accounting: understanding the purpose of vehicle use and its impact on emissions reporting. This is a key element because the way emissions are calculated and reported is directly tied to how each vehicle in the fleet is used. So, let's break it down. Basically, all vehicle mileage falls into three primary categories: business, commuting, and private. Starting with business purpose. This is all about vehicles used for actual business operations. We're talking about company cars driven by employees for work-related activities, not including their commute. Now, emissions from these vehicles, which are under operational control, like the company-owned or leased ones, are reported under Scope 1 and Scope 2. But here's where it gets a bit specific. For vehicles not under operational control, say employee private vehicles, how we report emissions depends on the company's policy. If the company is paying for fuel or electricity, these emissions can either fall under Scope 1 or 2 or be categorized as Scope 3, Category 6, business travel. Next, we have employee commute. This covers vehicles used by employees for commuting to and from work. For vehicles that are operationally controlled, their emissions typically fall under Scope 1, Scope 2, as per the GHG Protocol. However, different companies might have different policies. In some cases, these emissions might be reported under Scope 3, Category 7, showing just how varied company policies can be. As for emissions from non-operational controlled vehicles, like those personally owned by employees, they're classified under Scope 3, Category 7, employee commuting. And then there's private use. This is about vehicles used by employees for their personal matters outside of work hours. Generally, emissions from these vehicles aren't seen as the company's direct responsibility. But if a company decides to cover fuel or electricity for these private uses, then these emissions might be reported under Scope 1, 2, depending on the company's reporting strategy. Although these emissions are often not included in formal GHG reporting, understanding them is valuable for a full assessment of environmental impact. In each of these scenarios, the way mileage is allocated, whether for business, commuting, or private use, plays a crucial role in how we approach data collection, emission calculations, and strategies for emission reduction. It's essential for organizations to clearly define the purpose of each vehicle in their fleet. This ensures that emissions are accurately tracked and reported as per the relevant GHG Protocol scope, enabling more targeted strategies to reduce overall emissions and aligning better with environmental sustainability goals. After discussing operational control and vehicle use purposes, let's delve into a key aspect of fleet GHG reporting, the concepts of CO2 and CO2e. Now, when we talk about CO2, or carbon dioxide, we're referring to a specific greenhouse gas that's mainly emitted by vehicles, especially through burning fossil fuels like gasoline and diesel. In the world of fleet GHG accounting, keeping track of CO2 emissions is vital. Why? Because it's closely linked to how much fuel vehicles with internal combustion engines are using. But there's more to it. Enter CO2e, or carbon dioxide equivalent. This concept broadens our perspective. CO2e is a way to compare emissions from different greenhouse gases, all based on their global warming potential, or GWP. In the fleet context, we're not just looking at CO2, we also need to consider other gases like methane, CH4, and nitrous oxide, N2O. Each of these has its unique impact on global warming. For instance, the IPCC's 6th assessment report from 2021 tells us methane has 82.5 times and nitrous oxide has 273 times the greenhouse effect of CO2. So CO2e helps us translate these varying impacts into a comparable amount of CO2, giving us a unified metric to understand global warming potential. In environmental regulations and reporting frameworks, CO2e is often the required standard metric. This aligns with global protocols and standards. But here's the catch. It's not just about CO2e. We also need to report separate emissions of CO2, CH4, and N2O under Scope 1, which means calculating the emissions of each of these gases. To sum up, while CO2 emissions give us a direct insight into the most common type of vehicle emissions, CO2e provides a more comprehensive view. Understanding this distinction is crucial for fleet managers and environmental accountants. It helps them fully grasp and report the broader environmental impact of their fleet operations, ensuring they adhere to both regulatory requirements and the best practices in sustainability. Let's talk about something crucial in fleet GHG accounting: the types of fuel used and how they impact environmental emissions. This is a key area because the fuel type is a major determinant of a fleet's environmental footprint. In fleet operations, we deal with various fuels, each contributing differently to greenhouse gas emissions. We have traditional fuels like petrol, also known as gasoline, and diesel, as well as alternative options like LPG and CNG. These fuels are commonly used in internal combustion engine vehicles, hybrid electric vehicles, and plug-in hybrid electric vehicles. Here's an important term: the emission factor. It's the CO2e emitted when these fuels are consumed. For example, diesel might have a higher emission factor than petrol, but don't jump to conclusions yet. The overall CO2e emissions from diesel vehicles might not be significantly higher due to their better fuel efficiency. You can find detailed emission factor data from sources like DEFRA, the UK government's Department for Environment, Food and Rural Affairs. Now, let's shift to biofuels, like E85 and E100. These are derived from renewable resources like plant biomass. Biofuels have the potential to reduce GHG emissions compared to fossil fuels. Why? Because the CO2 released during their combustion is somewhat offset by the CO2 absorbed during the biomass production. The GHG Protocol has a specific way of calculating emissions from biofuels. It requires separating the Scope 1 emissions into CO2 emissions, categorized under Scope, Bio, and the CH4 and N2O emissions, which remain under Scope 1. For instance, in bioethanol, we see figures like 1.52 kilograms CO2 per liter for Scope Bio and 0.009 kilogram CO2e per liter for Scope 1 emissions. So, as fleet managers or environmental accountants, understanding the specific impact of each fuel type on GHG emissions is essential. This knowledge helps us to strategize better and make informed decisions to reduce the overall environmental impact of our fleet operations. Let's talk about a rapidly growing aspect of fleet GHG accounting, the role of electricity, especially with the rise of electric vehicles, or EVs, and plug-in hybrid electric vehicles, PHEVs. Electricity's impact on greenhouse gas emissions significantly varies depending on how it's generated. For example, renewable sources like wind, solar, or hydroelectric power typically result in lower emissions compared to fossil fuels like coal or natural gas. Now, when we calculate GHG emissions from electricity consumption, we use electricity emission factors. These factors reflect the average emissions per unit of electricity, measured in kilowatt hours, and they differ by region and country. Keeping these factors accurate and up-to-date is crucial for reliable emission calculations. For those of you diving into this data, you'll come across two types of factors: the generation factor, which measures the carbon intensity of electricity generation, and the T&D, or transmission and distribution factor. But here's a key point for fleet emission calculation. We focus only on the generation factor. As you can see in this graph, the average electricity emission factor varies by country. Countries like France, which rely heavily on nuclear power, have a lower emission factor, while countries like Poland, where coal-fired power is prevalent, have a higher emission factor. In the USA, it's even more granular, with states like California having a lower factor and states like Kentucky a higher one. Interestingly, in Kentucky, you might find that a compact HEV emits less CO2e than a battery EV, a clear indication of how the source of electricity can flip the environmental impact narrative. In some countries, you have special contracts for renewable electricity. These contracts allow us to adjust the emission factor of the consumed electricity based on the amount of renewable electricity used. This can significantly alter the emission landscape, as seen in the earlier Kentucky example, where introducing renewable electricity can shift the balance in favor of battery EVs. Regarding GHG reporting, electricity consumption for EVs and PHEVs generally falls under Scope 2 emissions, which are those indirect emissions resulting from purchased electricity. It's essential for fleet managers to understand and accurately report these emissions. Accurate reporting isn't just about regulatory compliance. It aligns with voluntary sustainability initiatives and accurately reflects the fleet's environmental impact. Let's dive into the data capture methodology in GHG emissions. Accurate data capture is the cornerstone of effective greenhouse gas accounting. Let's begin by understanding the operational control of our vehicles. Are they company-owned, leased, or employee-owned? Alongside, we need to know the total mileage for business, commuting, and private uses. This combined info is pivotal in merging with emission data for precise calculations. There are four main methods of data capture, each with its nuances. First up, market average calculations. They provide a broad estimate of emissions profiles and are handy for large fleet assessments. But, and it's a big but, they don't capture the specifics of your actual vehicle data. Plus, market averages don't account for proactive GHG reduction measures like using less polluting vehicles or cutting down on mileage. This makes them less ideal for strategic GHG reduction planning. Moving to the second method, we have specific vehicle data like NEDC and WLTP data. These offer detailed emissions and fuel consumption info under controlled conditions, particularly useful for ICE and HEV vehicles. But remember, these ratings are more about CO2 than CO2e. And for commercial vehicles with different load factors, these figures can vary quite a bit. The challenge with EVs like battery EVs, 0 gram per kilometer, and PHEVs, 30 to 50 gram per kilometer, these data may not mirror actual emissions, leading to discrepancies as we shift more towards electrification. Our third method involves actual dashboard fuel and electricity efficiency readings. These provide invaluable insights into real-world emissions, but gathering this data isn't easy. Techniques like connected vehicle or telematics systems can help, but rolling these out across all vehicles, including those owned by employees, is quite a task, as GDPR restrictions apply, and a significant OPEX needs to be available. The fourth method, and perhaps the most precise one, is tracking actual fuel or electricity consumption. This is typically done through fuel card systems or EV charging station metering. It's highly effective where feasible, but not all countries are equipped for this yet. Plus, properly categorizing the data between business, commuting, or private use remains a challenge. Many fleets blend these methods to enhance the accuracy of their GHG accounting. For example, they might rely on specific vehicle data where possible, use market averages for older or rarer vehicles, and back it up with real-time dashboard efficiency readings. But as you might know all too well, collecting all this data can be incredibly time-consuming and often involves extensive work with spreadsheets. To solve these challenges, why not consider introducing an application like Scopes Data that supports data collection? Regular validation and updating of data is crucial. It maintains accuracy, especially with changes in vehicle usage, fuel types, or energy sources. By employing these diverse methodologies, fleet managers can effectively assess and manage their fleet's environmental impact. It's not just about compliance. It's about developing effective strategies for emission reduction and meeting sustainability goals. This comprehensive approach ensures your fleets are as environmentally friendly as possible. Now, let's talk about the GHG Accounting Methodology, a critical component in fleet GHG accounting. We're going to look at different calculation methods, and for simplicity, let's assume we've got some specifics in place. Firstly, we can clearly identify which vehicles are under the operational control of the company and which vehicles are not. Secondly, we have a comprehensive breakdown of the mileage, categorized into business, commuting, and private usage. Thirdly, we possess detailed information on both fuel and electricity emission factors, relevant to the regions where the vehicles operate. Fourthly, we have accurate data on the actual fuel and electricity consumption for each vehicle. For Scope 1 emissions, which are all about direct emissions, we start by taking the actual fuel consumption and multiplying it by the fuel's emission factor. This includes emissions from CO2, N2O, and CH4 for each fuel type. Once we have those figures, we adjust them based on our company's GHG accounting policy. We apply the proportions of business, commuting, and private use to obtain our final numbers. Remember, for company-owned and leased vehicles, we typically consider both business and commuting emissions, but for private vehicles, even if they're used for business, Scope 1 emissions are generally counted as zero. To figure out the actual fuel consumption, you could use the fuel efficiency data and multiply it by the total mileage. This works well for both ICE and HEV vehicles. For PHEVs, we need to be a bit more specific and calculate the fuel consumption based on the portion of mileage driven using only fuel. When it comes to biofuels, we need to separate the CO2 emissions, which fall under Scope Bio, from the CH4 and N2O emissions, which are under Scope 1. We apply the specific emission factors for biofuels to get our numbers. Just like with regular fuel, for company-owned and leased vehicles, we adjust the total biofuel emissions based on the business and commuting proportion. For private vehicles, Scope Bio emissions are considered zero. Now, for Scope 2 emissions, which are all about indirect emissions from purchased electricity, we take the electricity consumption and multiply it by the electricity emission factor. The source of the electricity plays a big role here, whether it's renewable or fossil fuel-based. For companies using renewable electricity, we can adjust the country's average emission factor by the amount of renewable electricity used. This gives a more accurate picture of the environmental benefits of using green energy. Just like with Scope 1, We adjust these total emissions from electricity based on the proportions of business, commuting, and private use according to our company's policy. Typically, for company-owned and leased vehicles, we allocate the emissions from electricity to both business and commuting use. But for private vehicles, even those used for business, Scope 2 emissions are usually counted as zero. Moving on to Scope 3 emissions, which include emissions like business travel and employee commuting, the policy of the company plays a big role. For company-owned and leased vehicles, we often count these emissions as zero under Scope 3. But for vehicles not controlled by the company, we calculate total emissions, combining both fuel and electricity for PHEVs, or just fuel for ICEs and electricity for battery EVs, and then apply the business use proportion for Scope 3, business travel, and the commuting use proportion for Scope 3, employee commuting. And lastly, there are emissions considered out of scope. These come from vehicles used for non-business private purposes, whether they're company-owned, leased, or private. Here, we apply the private use proportion to the total emissions we calculated for Scope 3. All these methods highlight the diverse ways you can tackle GHG accounting in fleet management. It's not just about crunching numbers. It's about understanding the bigger picture and how every vehicle and its use contribute to your company's overall emissions. This is where the real challenge and opportunity lie, in aligning your fleet operations with broader environmental goals and strategies. So this is our deep dive into the GHG accounting methodology. Remember, every fleet is different, and so is every company's approach to GHG accounting. It's all about finding the right balance and methodology that fits your specific needs and goals. All right, as we wrap up, I want to leave you with some key takeaways. We've navigated through the complex and absolutely crucial world of GHG accounting. It's clear that getting a handle on emissions across various scopes, from the direct ones in Scope 1 due to fuel combustion, to those indirect emissions from electricity in Scope 2, and all the other indirect emissions captured in Scope 3, requires not just a basic understanding, but a meticulous approach and precise methodologies. What we've seen today is that the methods we choose for GHG accounting can really differ. It's based on several factors: who has operational control over the vehicles, how these vehicles are used, and the kind of data we have at hand. And let's not forget that the type of energy used, from conventional fuels to biofuels and electricity, adds its own layer of complexity to the GHG calculations. For fleet managers, I can't stress enough how big a role you play in this process. It's not just about ensuring that emissions data is accurately captured and reported. There's a need for close collaboration with sustainability teams to ensure that fleet operations align with the organization's wider environmental strategies and goals. This cooperation is absolutely key in developing and rolling out effective emission reduction strategies, staying on top of regulatory compliance, and contributing to the global push towards sustainability. So, remember, GHG accounting isn't just a box to tick for compliance. It's a strategic move that drives organizations towards greater efficiency, sparks innovation, and cements environmental stewardship. Embracing this challenge means companies not only adhere to regulations, but also showcase their commitment to a sustainable future, boosting their reputation, pleasing stakeholders, and, most importantly, doing right by our planet. I want to thank you for joining me on this insightful journey through the world of GHG accounting for fleet operations. I hope this session has equipped you with new insights and a solid foundation for understanding corporate environmental responsibility. I wish you all the best in steering your fleets, and indeed your businesses, towards a more sustainable and responsible future.